Transmile Group Berhad, Transmile, was once a prominent Malaysian investment holding company. It was involved in the provision of air freight, aircraft engineering, and maintenance services. This was a highly lucrative industry and required intensive capital investment to maintain and grow its business. Moreover, the company placed pride in itself for its stellar performances, operationally and financially, as well as its share price. Unfortunately, Transmile would be hit with one of Malaysia's most scandalous stories. The company in 2007 had been plunged in an accounting scandal. The company had materially overstated its revenues and profits, which meant that investors and the public community thought that Transmile was doing well. The result was nothing but negative consequences, both to the company and the many shareholders that believed in them. So, how did such a prominent Malaysian company fall to its knees? Well, to understand the Transmile scandal, let us first have a quick history overview. Transmile was founded by Gan Boon Aun in November 1993. In just a few years, on June 27, 1997, the company was listed on the Bursa Malaysia Securities Berhad, Bursa Malaysia. This meant that ordinary people like you or me could have bought shares into the company and become a shareholder. They issued 6.04 million new shares at 5.20 Malaysian ringgit per share. At that time, Transmile had 6 subsidiaries. The first is Transmile MSDN BHD, which trades and leases Cessna Caravan and Pilatus Britain Norman aircraft, for which it is the sole representative in Malaysia. The second is the Transmile Spares SDN BHD, which stocks and supplies aircraft, spare parts and accessories. Thirdly, the Transmile Aircraft Engineering SDN BHG, a provider for aircraft engineering, technical and maintenance services. Fourth, Transmile Management SDN BHG, which offers management support and services for the Transmile Group. Fifth, Transmile Air Services SDN BHD, which provides air transport services. Sixth, and finally, Transmile Aviation, which handles aircraft ground services. On top of that, Transmile was operating a fleet of 7 Boeing 737-204 Cessna Caravans for its air cargo business and air passenger charter service. A large portion of its business relied on its air cargo operations, which accounted for 60% of its business activities, with the air passenger charter service making up the remainder. Through these businesses, Transmile's after-tax profit was about 9.87 million ringgit in 1996. The company, in just a small amount of time, was already a rising star in the Malaysian landscape. In 2000, the company was looking to grow big and fast. They were looking to focus on the niche market of regional air freight services that would yield substantial returns, given the projected strong growth in the industry over the coming years. They had expanded their network rapidly, which it has been doing since 1993. The company was not only operating in Malaysia, but was not operating freighter flights to destinations as far as India and China. Moreover, the company, which started with only 2 fleets, a Boeing 737-200F and a Cessna Grand Caravan II, Transmile has now grown its fleet to 10 aircraft by 2,000. To meet future demand, the company was planning to add more aircrafts. They wanted 2 more Boeing 727s, which, as Gan said, were chosen because of their low startup cost and high cargo capacity compared to other aircrafts. Transmile was also playing a pivotal role in establishing Kuala Lumpur as a regional cargo hub. The company operated in a 60,000 square feet cargo facility at Sultan Abdul Aziz Shah Airport in Subang, which it acquired from Malaysia Airlines following the opening of Kuala Lumpur International Airport. In 1998, Transmile posted a pre-tax loss of 11.94 million ringgit on a turnover of 162.9 million ringgit. However, the company rebounded in the following financial year with a pre-tax profit of 16 million ringgit on a turnover of 111.1 million ringgit. By 2004, a family with deep shipping connections had acquired a controlling interest in Malaysia's largest air cargo carrier, Transmile Group. A company owned by Malaysia's Kuok family has purchased a 28.5% stake in Transmile, according to published reports. Transmile's latest annual report indicates that Chief Executive Officer Gan Boon Aun and Director Kudin Mohad were previously the largest shareholders, holding stakes of 21.67% and 13.93%, respectively. The Kuok family, led by tycoon Robert Kuok, already controls Malaysian bulk carriers BHD. They also own Singapore-based shipping company Pacific Carriers Limited and Hong Kong-based Kerry Logistics, which offers contract logistics, distribution centres, and international air and sea freight forwarding. This acquisition earmarked an important piece for Transmile. The entrance of a famous businessman says nothing but confidence in the company. Why would someone of status buy a stake in a company if it was a failing one? He, like every other shareholder, believed in the dreams of Transmile. Following this change in shareholder structure, they had appointed new people in their boards. Former Minister of Transport, Ling Leong Sik, replaced Gan as chairman, but Gan had remained in his role as Chief Executive Officer. In 2003, Transmile had reached a net profit of 38.1 million ringgit and had revenues hitting 289 million ringgit. This was driven by their new business ventures, capacity expansion, and improved aircraft yield. Gan had also announced that Transmile has begun operations to China and Taiwan via Macau, highlighting significant growth opportunities in that segment of the market. Gan said that they aimed to replicate the success of their Malaysian operations in China, which offers a larger domestic market to capitalize on. Unfortunately, 2004 and the following years were the start of their accounting fraud. In 2007, news was spurring out. People were calling out for suspicion about Transmile's accounting statements. An asset management firm said that this was a Robert Kuok company, and people were quite surprised that there were problems with its financial statements. Transmile was no longer a small company, but they were also the firm delivering mail and parcels for POS Malaysia, the national postal company. Billionaire Robert Kuok was also named as Southeast Asia's richest man. Shareholders also included the National Postal Company and foreign entities like the Capital Group, Goldman Sachs, and the Singapore government. A look at its track record explains why the company is favoured by foreign investors. It has reported rising net profits since 1999. Revenue has grown ninefold to 989 million ringgit in 2006, according to its unaudited accounts. In addition to POS Malaysia, Transmile's major customers include DHL, Worldwide Express, and United Parcel Service. The company now also has over 20 planes and has grown beyond the local market to operate internationally. Transmile now flies regularly to countries like China, Thailand, and India, with other destinations, including major cities in the Asia-Pacific region, and plans to open new routes. So, what could go wrong? Well, everything. In July 2007, 3 former top executives of Transmile Group BHG, Gan Boon Aun, Loh Chok Ping, and Kudin Mohad, were charged with abetting the company in making a misleading statement about 338 million ringgit in reported revenue. This pertained to the company's quarterly report, containing unaudited, consolidated results for the financial year ending December 2006. Due to insufficient bill support and audit failures, the group announced a special audit. The special audit by Moores Rowland Risk Management revealed pre-tax losses of 126 million ringgit and 77 million ringgit for fiscal year 2006 and fiscal year 2005, respectively. Contrary to the originally reported pre-tax profits of 207 million ringgit and 120 million ringgit. This meant Transmile overstated its revenue by 197 million ringgit in 2005 and 333 million ringgit in 2006, totaling 530 million ringgit. This accounting fraud severely damaged the company's reputation, causing its share price to plummet as foreign investors rushed to sell their shares. Regaining investor confidence became challenging. The company violated corporate governance principles by deliberately deceiving the public and investors, falsely reporting losses as profits. The company was then categorized as a Practice Note 17 company in 2010 and was eventually suspended and delisted from Bursa Malaysia in 2011. The battle in the court, however, was just beginning. It did not take years for the trial to conclude. It took over a decade. They delivered the sentence in August of 2020. Sessions Court Judge Hasbullah Adam sentenced Gan to a 2.5 million ringgit fine and 1 day in jail. Judge Hasbullah stated that the defense failed to prove that the misleading statements to Bursa Malaysia were not a result of Gan's consent as a director, or that Gan had exercised due diligence to prevent the offence. Gan, along with former CFO Lo Chok Ping and former executive director Qudin Mohammed, was initially charged in 2007. Lo was later released after paying a 700,000 ringgit compound, and Qudin was acquitted in 2016. People all across Malaysia were shocked by this sentence. 1 day in prison and a mere small sum of 2.5 million ringgit fine. How could a man who overstated revenues by over 530 million ringgit be only fined so little and be sent to prison for so small? The battle continued for this one. The High Court actually increased Gan's jail sentence to 2 years from 1 day in 2022, but that was overturned in 2023 by the Court of Appeals, which reinstated his former original sentence of just 1 day. But anyway, do let us know what you think. Thanks for watching.